Hi, this is Tom Suvansri, Premier Trust Advisors. Thanks for joining me on this webinar. I'm so excited that you are joining me. I think you're going to get a lot of value out of it. I'm going to share some lessons I think will help you on your personal financial journey. But before we get there, I want to take you back a little bit, nearly 20 years. I had just finished my MBA Finance, was really excited. I was going on my first assignment overseas, and I decided to check my credit report. And what I found was incredible. And I remember saying, no way was this right. This can't be true. And what I uncovered was that there was nearly $50,000 of debt that was under my name that I didn't know anything about. Now, I assumed it must have just been identity theft. And I was angry about it, frustrated. And so I started investigating and researching it. And what I uncovered that it wasn't due to someone I didn't know, it was someone I knew very well. And it happened to be my mother. In desperation, she ended up having to take out money in my name because of some of the financial issues she and my dad were going through. And it was a really pivotal moment in my life, just getting out of school with a bunch of debt already accumulated from school. And it really taught me the need to really be responsible for my own personal financial life. And, a lot of it started for them, my parents, back when my father came over. He came over from Thailand as a medical student to do his residency. And through the course of time, he built up a nice practice in New Jersey. My mom was the office manager. They raised us in a great upper middle income neighborhood in New Jersey, and life was great. I still hold such great memories of my childhood, and I appreciate them being able to give us that life. But for them, it was a lot of turmoil. They were never taught about how money works, and didn't have much financial education, so they didn't do some of the basic things like saving money and protecting their wealth and investing in things that they knew or could control. And it spiraled out of control for them, and it caused them to owe tons of taxes and caused their practice to go under, and they had to file bankruptcy. And then it eventually led them to be separated and their marriage to dissolve. And a lot of these things have really pushed me to explore, right? How do I take control of my own personal financial life? So those sorts of things would never happen to me. And I initially started with the basics, right? The millionaire next door. Let me cheat my way to financial wealth. Right, scrimp and save and clip coupons and then save as much as you can. And by the time I retire, I'll have so much money to be able to enjoy. But I quickly learned that was not for me. It was not that enjoyable, and I had to find a better way. And then I came across Rich Dad Poor Dad. It was a thing I'd never seen before. Talk about real estate and entrepreneurship, and it really was different than anything else I had seen. And it took me a while to finally come to grips with it and do anything with it. I read it and didn't do anything, and stayed the course with the typical stock market stuff and putting money in 401ks and doing what the typical advice tells you to do. And then experienced 2001, and then in 2008 hit with the housing crisis, and I just felt like I didn't have control over my money. And you're going through these cycles of downturns and bear markets and bull markets, and it just felt like a roller coaster to me. And so I knew I needed to find a better way, and that's where I finally went back to that Rich Dad Poor Dad and started reading more around real estate and alternative investments and what the wealthy were doing with their money. And they were doing pretty much the opposite of what I was doing. They weren't just accumulating money into accounts and hopefully it was growing. they were using leverage and having their money continue to work for them and minimizing taxes. And so all these strategies I've learned along the way were due to the fact that I was seeking that control over my own money. And I've been fortunate enough to come across it. And now it's compelled me to start my own practice, my own business, where I get the fulfillment of helping educate my clients on how money works so they can maximize every dollar that comes into their lives for what's most important for them. And so I believe that everyone has the ability to control their wealth and grow it, and with less risk and cost to them, and be able to set up a lasting legacy that will, span generations. And so in the next 30 minutes, I'm going to share just 3 lessons that we can take from the pandemic we've just are still going through that will help you control your wealth and help you create a stress-free retirement and avoid the pitfalls that people may face that will prevent people from enjoying their wealth over their lifetime. So I'm really excited for you to be here, and I think you're going to get a lot of value in it. So let's get rolling. So thanks for joining me on this webinar. I'm super excited to share how to secure a stress-free retirement. I think everyone wants that, right? You worked your butts off to create the wealth for you and your family, and you want to enjoy it without a lot of the pressure and stress that may come with markets and such. And unfortunately, a lot of the typical advice is positioning people to have a very pressure-filled and stressful retirement. So I want to share the 3 critical lessons that the coronavirus has taught us about investing for retirement. So who is this webinar for? So this is for anyone who has taken their finances seriously and is looking for opportunities to maximize their wealth with less risk, costs, and stress. Now, in the next 30 minutes, I'm going to cover how to position your assets so you can avoid the biggest threat of loss to your wealth. How to maximize the use of your wealth in retirement, even if there's a significant downturn in the economy or markets. And lastly, how to save and store your safe dollars so that they're accessible when needed and productive when not. So the first lesson that we need to cover is that tax diversification is needed now, more than ever. A lot of the focus in the personal financial world is around investment diversification, which usually is tailored towards your mix of stocks and bonds. But where you're positioning your assets from a tax perspective is hugely important, because it's not what you make, it's what you get to keep and use. Now, Ben Franklin said it the best. He said, "In this world, nothing can be said to be certain except for death and taxes." And unfortunately, when the tax code was created back in 1913, it was supposed to be a temporary thing. Unfortunately, we're here a century later, and it's still with us, and there's no signs it's going away. So when we think about some of the basic principles and advice around saving for retirement, a lot of people are putting money in retirement accounts, such as IRAs, 401ks, and there's a whole host of letters and numbers that are being created based on a qualified plan and retirement account. And so there was always still a push to shoot for that $1 million, which certainly doesn't feel as much anymore, but still $1 million is a good chunk of money. And so because of the way we are being taught even from CPAs and financial advisors to defer taxes, we're basically postponing the taxes on this. So as we migrate towards retirement, and there are certainly controls and rules on how to use this money, the reality is that not all this money is ours, because the IRS basically has a lien on a portion of this money. But the stark reality is we don't even know how much that is, because we don't know what tax rates will be in the future. And for a quick example, say you want to use $15,000 from this account. Well, to be able to use a net spendable amount of $15,000 at a 25% tax rate, you're going to have to take out $20,000 because you're going to have to pay the taxes on it. And it just goes to show you that not all this money is ours. Now, when the typical advice around of using deferred accounts and qualified plans like an IRA, the assumption is that tax rates will be lower in retirement. And that comes with a few assumptions. One being that you could actually have lower income in retirement. That would result in lower tax rates. But let me ask you, if you're in retirement and every day feels like a Saturday, do you think you're going to need less income to enjoy your lifestyle or more? And so planning for a lower income in retirement, to me, does not sound like financial success. The second option is that they actually reduce taxes. And most people I ask, they believe tax rates are going up. But who knows? But let's consider this situation. What if $1 equals a second? $1 million equals 12 days. $1 billion equals 36 years. And $1 trillion equals 36,000 years. But today, when we look at the US debt, we're at $26 trillion and growing. We just added $3 trillion recently through the stimulus package from the Fed and the government. So this is a growing problem of a massive amount of debt that the government's only taking in $3.5 trillion of revenue through the tax system. So this is a problem that eventually will have to be addressed. And one way will be by increasing taxes. Now, we also have this other problem that the population is aging. This is becoming a math problem because when Social Security itself was created, there were a lot more people funding the Social Security program versus who was actually utilizing those dollars. And as time has worn on, as our population starts to age and more baby boomers start to retire and approach the use of Social Security and Medicare, that the population, there's going to be fewer people contributing to these programs compared to who is actually using the programs. And now today we have over roughly around 157 million people filing tax returns, but only 100, and of those 157 million, 123 million of them are actually filing returns and not paying any federal income taxes based on their income levels. So the 34 million people are bearing the burden of the taxes that are required for the government. Now, on the other side, just like we talked about the population aging, that 169 million people in this country are taking advantage of the government programs through medical care or income from the government. And that represents nearly 50% of the population is on that, and it's going to continue to grow. Now, if we look at historical tax rates, we see this spans from the beginning of time when the tax code was created back in 1913. You see over the course of time, there are times when tax rates were extremely high, especially in times of war, World War II, Vietnam War, where we were increasing tax rates to fund the wars. But if you see on the later stage of the decades, we see tax rates are pretty low in comparison to history. And that shines a light on the amount of debt that this country has had to take on to fund those other services and wars that we've gone through. But we've kept the tax rates pretty low. Now, Ronald Reagan back in the day, he actually was experiencing pretty high tax rates at his time when he was working in the movie business. And supposedly it turned him from a Democrat to a Republican because after working at 2 movies, he had already maxed out his income to a point where there was no incentive to work anymore because the tax rates were so high that they were all going to go to the government. So what was the point to do any more work? And since Trump President Trump had gotten into office, there has been a tax rate change during his administration. And so in 2018, they were reduced. The tax rates were reduced. And so there is a window of opportunity here. And it's going to end in 2026 when the tax rates, the discounted tax rates, are actually going to, by law, go up if nothing is done. And depending on who else is in office at the time, and it could be very different. And so we do have a very tremendous opportunity here to take advantage of lower tax rates that will help protect the assets going forward in the future from the threat of high taxation. Now, we talked about a little bit about the deferring money, and for a vast majority of people in this country, most of their assets are sitting in the first bucket, tax deferred, whether it be through an IRA, 401k. And in the middle bucket is taxable accounts, right? They are your brokerage accounts and your investment accounts like a Merrill Lynch, where you can get taxed on capital gains based on your selling in your mutual funds and dividends you may obtain, or interest earned from bonds. Those will all be taxable now on those gains at potentially ordinary or capital gains rates. And then the last one are tax-free. Now, obviously you pay tax on it first, the seed, but then at the harvest time, when you go to use those assets, they will not be taxable. So what if you're able to figure out ways, based on what I'm saying, to move some of the assets to a tax-free environment? And for most people thinking about that, the first thing that comes to mind is Roth IRAs. Well, for a lot of people, their incomes are too high, they can't contribute, or when they can contribute, it's not that much. So where do you find tax-free assets and strategies that you can start positioning your assets to get out of the way of an impending tax increase that may come down the road? If you could move it over, how much would you want to move over and avoid the pain of future taxation? Now, there's a book I want to encourage you to read, and it's a gift that I want to offer to you, and it's called Smart Retirement, a tremendous book that offers a lot of different strategies to reposition assets to take advantage of tax rates today and avoid them in the future. And because everyone's situation will be unique, it will require going through a process to uncover what opportunities are available to you. And so this book itself will share some strategies to maximize your retirement income, minimize taxes, and put you in a position to get out of debt and be out of debt forever. And if you want to secure a copy of this, I can send this book to you. Just go to my website and put in your information, and I'll send that to you. And it's valuable, extremely valuable tool. So the second lesson I want to share with you as it relates to retirement investments is that the speed and severity of volatility is greater than ever. When we think about saving and personal finances, most of the people who are pre-retirement are in the accumulation phase, and the strategies around putting them in accounts and hopefully they're growing and compounding, that is the focus. And the focus is on what's the rate of return I can earn here, the highest one I can take with the least amount of risk. However, that's not really our end objective. Our objective is to create the maximum amount of income to be able to enjoy when I'm no longer working. And that is part of the retirement and distribution phase of your life. And that requires different thinking, different strategies than what got you through the accumulation phase. However, a lot of the typical advice still maintains a lot of those thoughts and focus on rates of return as opposed to withdrawal rates and creation of cash flow. And it just requires different thinking, different mindsets, and different approaches that goes outside the typical advice. And when we think about the historical performance of the S&P 500, the stock market, obviously thinking back to the late 90s, that we had this up and down sort of scenario here, especially around 2008 with the housing crisis, the mortgage crisis, and And through that time, in this decade, from 1999 to 2009, you basically lost all the gains that were created during that time, and basically it was considered a lost decade, right? But thankfully, for the folks who are invested in the stock market, it's done very well since 2009. We've had the longest bull market that anyone's experienced before. And you saw the pandemic and the impact it could have very, very quickly, that a lot of wealth can be erased overnight in a matter of days. And so the question mark is, it's gained so much, and there's certainly uncertainty going forward. We are sitting in the longest bull market. What direction do you think the market will go? And how much of your assets do you want to protect to ensure that it's not lost? And let me go through an example of rate of return, and because it can be misleading. So imagine in year one, you had 100% return in your account, which is great. But in the second year, you lost 50%. In third year, another 100% uptick. And year four, another 50% decline. So what is the average rate of return that you would experience from this? Well, you have 200s and going up and 250s going down. Your average rate of return is 25%. And that's the type of rate of return that you're going to see across the board from anyone who's advertising performance in the stock market and mutual funds. But the money itself tells a different story. So say we go with the same example of, say that $10,000 earning 100%, you have $20,000. What if you lost 50%? You're back to $10,000. Year three, 100% gain gives you that $20,000. But that 50% loss gets you back to square. And that's with no fees, no taxes, anything in there. You basically you're back to where you started. But what is being shared is that you have a 25% rate of return on average. Is that really what you expected out of your accounts? So what this really illustrates is the losses have a much bigger impact to the performance of your accounts than the gains. And that's why protecting loss is hugely important. So what if I told you you can earn 14.84% in your retirement accounts for 30 years, right? You hire me in a second, right? Anyone would, right? It's just a great rate of return. And through a time frame back in the 1979, things started this time frame, you had these great returns in the market when mutual funds were getting really introduced and people were investing more in the stock market. And so in that scenario, if you had $1 million, don't you think if you're earning 14.84%, you can take 10% out? That's like $100,000, right? 10% of $1 million. Well, if you did that in this scenario and earned 14.8% every single year without fail, your account would be $15 million by the end, even taking out 10% every year. That's a great account. That's assuming a constant rate of return. But the reality is that's not how it works. It fluctuates year after year after year. And here it is, 1970, where it has fluctuating returns. Do you see 14.84% anywhere on this map, in this grid? No, because it does go up and down, but we're going to take the average. And so when you apply that, assuming you took in this situation $100,000 out of this $1 million account, by year 14, you've essentially run out of money. And this is the highlights this sequence of returns risk that happens because of the volatility of the stock market. The losses, as we noted, have a much larger impact than the gains, and the timing of them are super important to retirement. So in those 3 years of losses created the fact that it was hard to catch up. And if you continue to take the $100,000, you run out of money. So here's where I bring in some sage investors out there, right? He's a successful investor with some good advice. Warren Buffett, rule number 1, don't lose money, never lose money. And rule number 2, never forget rule number 1. And so one way to avoid that is to pool risk through the use of actuarial science, right? This is using math and statistics to help evaluate and prevent loss and mitigate risk and share the risk across people. And that used to be part of a big stool of the 3 parts of retirement before. You had Social Security, personal savings, and the bottom left is pensions. And what that uses actuarial science. And what are they? Annuities. Because in reality, what most people want is to protect their principal, make sure it doesn't lose. When asked, what percentage of your assets are you comfortable losing in retirement? The majority say 0. Well, obviously, as you see within the stock market, that's a possibility. And you're dealing with volatility and stress and pressure on your accounts. And you're trying to mitigate against the biggest risk in retirement is the longevity. Nobody knows how long they're going to live for. And so when you're not sure what is going to be produced from your assets, it will prevent you from being able to use as much as you want to in retirement because of the fear that it could be lost. So for a portion of assets, it can be wise to protect that asset and use it to maximize and create income that you can never outlive. So here's a quick recap of where we've been. So now we know that tax diversification is needed now more than ever, and the speed and severity of volatility in the markets is greater than ever and will likely continue. So now let's look at why liquidity is so vital to survival now and in retirement. So we know liquidity is vital now and always because having emergency funds is something we're always going to have, especially in retirement. We're going to need some because we don't know what's going to happen around medical care, and there's just going to be naturally things that we weren't expecting to happen that we need to be able to fund. And we see that much more evidently now when a sizable amount of the population couldn't withstand a little time away from paychecks. And so they're needing government assistance to be able to sustain their lives. That's why having these emergency type funds are so key. Now, when we direct our attention back to the volatility of the stock market and sequence of risk, this is where assets that are safe and able to be utilized for emergencies come into play. So in the situation where by year 14 in this scenario, if we took out that $100,000 each year, assuming we're going to get 14.84% every year, it's due to the fact that there's a couple years where there's losses, a few years of losses. So one of the strategies around this is for the years that after a loss has occurred, and instead of utilizing the account for income, use an alternative non-market-based asset to fund your lifestyle and allow your assets in investment accounts to regrow and recoup, because typically they do. They've seen that in history. So, but dealing with the volatility, knowing it's going to happen, this allows you to prepare adequately so that you can maximize your income. In this situation, if you had 3 years worth in this situation of $100,000, $300,000 of non-market-based assets that you can withdraw from that were not allocated for anything else, you can use it for this situation, use it for income, and allow the accounts to grow. And because of that, not only are you going to be able to maintain the $100,000 a year of income, but the account actually grows to more than $1 million by the end of 20 years instead of running out in year 14. Really powerful, and it helps to highlight the need to prepare for the volatility that will likely come in the future. So where do most people store this sort of safe money that's non-market based, that is no chance of loss? Well, for normal emergency funds, it's a saving or checking account. And unfortunately today, it's not really earning all that much in terms of rates return. And it for while interest rates remain very low, it's likely going to stay that way. You can have money market accounts or CDs that may pay a little bit more but lock up your money. T-bills that are under 100%, 1% right now for short duration. And then some people want to use their home equity lines to maybe use as an emergency type fund. But even today, there are banks that are not even allowing you to access them, and then they can always take them away given the situation in the housing market or the credit market. So, a lot of these alternatives come with shortfalls in terms of rates of return or benefits, and then even accessibility. And when you look at going forward, even this is a Vanguard sort of projection for the next decade as it relates to fixed income type products, whether it be bonds or treasury bonds and bills and cash, that the rates of return on these things are not even going to exceed inflation. So money tied up in these sorts of accounts are going to actually be losing value and losing wealth for you because it can't even keep up with inflation. And the amounts, and most of them are going to be taxable. So where can you find an account that could serve a purpose and still be productive for your wealth? Well, savings account, we talked about that. Qualified plans, 401ks, they typically have four mutual funds and stocks in them. So this is not a good source because most people are looking at something that they can be safe, it's liquid, has a decent rate of return, and has some tax advantages. Home equity lines can have some benefits in terms of how they're taxed, and they can be liquid, but they really don't earn anything, right? They're sitting in your house. The stock portfolio that we've talked about can be using a margin call account and such, but it has some safety issues. It could be volatile and having some negative tax consequences. But the best place we found to store your safe money that is both safe, liquid, has a good rate of return, and has very favorable tax advantages is uniquely designed whole life insurance. So when you think about it, in comparison to a bank and life insurance, right? So banks are safe. You have the FDIC, and life insurance actually holds more reserves on the books because they're required by law, and they have state guarantees, just like the federal ones. And for banks, unfortunately, you're getting pretty low interest rates on the holdings in those accounts, and they're taxable. In life insurance, you can earn 2 to 3 times what you earn at a bank. Right now, we're talking about for in the long run in the range of 3.5% to 4.5%, 5% tax-free, right? Tax-free growth in there instead of taxable in the bank. And it's easily accessible in a bank, of course, right? You can withdraw it. And life insurance requires a little more work, but you can withdraw the money there, and you can even get a loan that's guaranteed by the life insurance company using their money and not touching your own, that they're guaranteed based on how much cash value you have built up in life insurance. And then the life insurance policy is a life insurance policy, so there are protections along with it. Outside death and disability, they protect from creditors and lawsuits. They'll continue to fund this if you get disabled. If you were funding or saving money in the banks, that stops once you get disabled and don't have income. And obviously you have this death benefit that's tax-free to your heirs. So in this situation, pennies are securing dollars that can help you build your net worth and help preserve your legacy and give you access to use more of your money in retirement. And lastly, it provides some protections against chronic illness and long-term care in some scenarios where you can add them onto the policies. So you can see at a minimum that the earnings are going to provide a lot more for you over in the long run and tax advantages, but also provides all these other benefits that help you protect and even grow your assets. And so most people would never think about it this way, but banks actually hold a tremendous amount of life insurance for tier 1 assets. So here in this situation for Wells Fargo, their tier 1 capital, which is their safest assets, they had to keep on reserve by law, that for Wells Fargo, their biggest tier 1 asset is life insurance and annuity values, even more than what they have in their fixed assets, their buildings, or even their pension plan. So they have a lot of money that's sitting in life insurance. And when we think about retirement plans, well, a lot of executives are funded through life insurance, like Ken Lewis and this, who actually CEO of Bank of America, had a $53 million policy that's part of their executive retirement plan because they know the tax advantages to it. the use of that money, and there's no chance of it being lost. So it's a tremendous spot that a lot of executives are funded as part of their retirement. So here's a quick case study. So Michael is an entrepreneur and business owner. He had a long, successful career in corporate America, and he started his own business, helping others unleash their power to do what they do best through innovative approaches like design thinking. Now, when we met Michael, he was a little nervous about the direction of the stock market. Obviously, we've seen a sizable increase over the last 10 or so years, and he was certainly concerned about the future tax rates, and he wasn't sure if his assets were positioned in a way that was going to create the most income from him in retirement. And he realized the value of going through a deeper analysis of all the aspects of his financial life. He had never looked at it before in that level of detail. And he knew enough around his finances, but taking that deeper dive really helped him see how his assets were coordinated and where maybe some gaps were. So through our work together, we helped him gain more control over money by positioning some of his assets away from the threat of higher taxes through the use of life insurance and other sorts of strategies. We took a portion of his assets to protect it from the risk of loss forever and position it so when it was time, he could use it to create additional streams of income that he could never outlive and would continue to rise in value to beat inflation. And we also set him up to be able to pass on substantial wealth to his beneficiaries or other things he cares about if he was so inclined to do so. So through that process and using the tools we have, he was able to uncover opportunities that weren't there for him before and alleviate some of his concerns. So we covered a lot today, and today I promised how to position your assets so you can avoid the biggest threat to loss of your wealth. How to maximize the use of your wealth in retirement, even if there is a significant downturn in the economy or the markets. And how to save and store your safe dollars so they are accessible when needed and productive when not. So here are the key lessons to win in retirement. First, tax diversification is needed now. It's not just about the investments and how diversified they are. We need to understand what accounts and where they sit and what risk are they to future taxation. Two, the speed and severity of volatility is greater than ever. And this is, you see with the pandemic, how quickly those values can change. We have to recognize that's just the way that the markets work and how to prepare so we can still survive and thrive in those times. And lastly, liquidity is vital for survival. There's a lot of things we don't know what will come down the line. We have to have ample emergency funds to deal with those situations, but we also don't want them to be sitting idle doing nothing for us while they're sitting waiting for us. So now you have a choice. You could take some of this information and take it as good information and do nothing, and you kind of go on your path that you're set out for. Or you can step forward and start actually taking a deeper dive in what's going on in your financial life and explore opportunities to make it even better. So how can I help? So I've set aside some time to speak to you personally about how you can apply these ideas to your own personal finances, starting today. Whatever your biggest challenges are, we've seen it and we know how to overcome it. So on the strategy session, we'll work with you to craft a game plan to secure a stress-free retirement so you can enjoy more of your wealth. And the cost is absolutely free. So who is this for? So you really need to be fully dedicated to addressing and fixing any of the issues in your financial life. And that requires taking responsibility and following through on your commitments. You must be open-minded to exploring new ideas, and you must be eager and willing to continue to learn, because a lot of the things that we're going to share are not what the typical advice would be pushing. And if that's you, I urge you to book a session now. So why are we doing this? So we do this because we love it. I love seeing individuals become empowered and to make the most of their personal economies and what they've done in their lives so they can do more for themselves, their families, and those around them. Plus, we know that you might want help to do this and transform your financial situation from good to great. If so, we can discuss it and see if it's a good fit for both of us. If not, that's fine too. Imagine taking 45 minutes of your time could greatly impact the next 45 years of your life. So if you're ready to book a strategy session, here's the link you can use to book a time that's convenient for your schedule. And I really look forward to meeting with you. Now, before I let you go, I want to share one last story with you. And it takes me back to the time when I started learning a little bit more about real estate. I went to a real estate meetup for the first time, and I was kind of nervous about even attending. I didn't know that much about it, and just nervous about going in as a beginner. And then when I got to the meeting, I almost didn't step in. I was just a little fearful what the event may turn out to be. And so I did muster up enough courage, and I walked in, and I did meet some folks and learned some things, but I didn't feel like I got too much out of it, and it wasn't a successful event for me. I kind of walked away kind of the same as I started, and so I decided to leave to go home. And as I was leaving, I saw someone that for some instinct I went to go talk to him and introduce myself, and we hit it off really well. I learned quite a bit about him, and he was a real seasoned real estate investor, and we had a lot of common things about each other that we had an enjoyable conversation. And from that, we ended up meeting a bunch of more times afterwards, and getting to know each other and our backgrounds, and we ended up working together. I helped him fund a deal for his real estate investing, and over time he helped me secure my first rental property, and over the years we've done a lot of business together and connected each other with our extended network to really help each other grow in a lot of different ways. So the lesson I took from that was that sometimes you need to break out of the status quo and have the courage to kind of go into areas that are uncomfortable and face some of those fears, because they'll help you move forward and grow. So you just never know where it will lead to, and that's the beauty of it. So I appreciate you joining me on this webinar, and I really hope to meet some of you soon and see if there's things we can do to help improve your financial life. Thanks.